Stochastics is an oscillator, which means it can help determine when a currency pair is overbought or oversold. To say that a currency pair is overbought or oversold, we simply mean that the buying or selling pressure has run out of steam, making a reversal in price direction more likely. If buying pressure has run out of steam, we can expect prices to fall sometime in the near future. Awareness of this situation can help us better time a good selling opportunity. Alternatively, if selling pressure has run out of steam, we can expect prices to rise sometime in the near future. Awareness of this situation can help us better time a good buying opportunity. Stochastics can be used to help locate these situations, allowing traders to better time their entries and exits. Let's talk about how you can use slow stochastics in your trading. The situation you want to look for in a potential buying opportunity is to note a pullback down to support when the market is in an uptrend. A potential selling opportunity is a rally up to resistance when the market is in a downtrend. While many traders can identify a move against the trend, they do have a tough time determining support and resistance, or the entry point and the initial stop level on a trade. Therefore, let's talk about how stochastics can be used to better estimate these price levels. The stochastics indicator is plotted with values from 0 to 100. The value of 100 is considered overbought, with the likely chance of a reversal to the downside. The value of 0 is considered oversold, with the likely chance of a reversal to the upside. Traders will further identify any reading of 80 or higher as overbought, and any reading of 20 or below as oversold. So the thought process is that when the market moves to 80 or above, the market is likely to reverse to the downside. And when the market moves down to 20 or below, the market is likely to reverse to the upside. But markets are known to stay overbought or oversold for long periods of time. This is really what identifies a strong trending move. We don't want to look for sells when the market is in a strong move up, or to look for buys when the market is in a strong move down. So the key to using this indicator, like all other indicators, is to first identify the direction of the trend. When the market is in an uptrend, we want to note those periods that the slow stochastics moves down to oversold, and look to buy that reversal back to the upside. We also want to look to sell when the market is in a downtrend and the slow stochastics moves up to the overbought level. This chart shows the market in a strong downtrend and a move by the slow stochastics to above 80. This is a classic selling opportunity. We simply look for the slow percentage K line to cross below the slow percentage D line to signal our sell entry. It's important to wait for the candle to close on the chart to make sure the crossover has been confirmed. Crossovers can be noted in the middle of a candle, but change before the candle can close, so wait for confirmation before acting. Since we're entering the trade after the reversal, we can identify the high as resistance and use that level for our initial stop. Traders will place their protective buy stop a few pips above the high, with the thought process being that if the market moves up to a new high, we don't want to be in a sell trade. Now let's take a look at a buy setup. Here we see the market in a strong uptrend. So we want to note when the slow stochastics moves down to the oversold condition, which is 20 or below. Once again, we look for the crossover by the slow percentage K line over the slow percentage D line. We wait for the candle to close in order to confirm that the crossover has taken place. We then buy at the open of the next candle and place our protective sell stop a few pips lower than the low. There will be times when we buy or sell, and the market will move to stop us out of the trade. After all, markets can do what they want, when they want. A big order may come into the market that temporarily pushes the market down to a new low after we bought, or up to a new high after we sold. But slow stochastics can also give us a second chance to enter into a trade if we wish. Let's look at an example. Here we note that the trend was up, so we bought on the crossover after the slow stochastics moved to below 20. The market started to rally, but then some selling pressure temporarily pushed the market down to a new low. However, note that the slow stochastics did not move down to a new low like the market did. This is known as positive divergence. It is simply when the market moves down to a new low, but the slow stochastics does not. This is a bullish signal and gives a trader an opportunity to enter once again into a buy position. They simply note the second crossover and treat it as a new trading opportunity. This means they place their protective sell stop below the second low and look for continued buying interest to push the market up. Here's an example of a second selling opportunity. The first crossover was confirmed with the sell being at the open of the next candle, but the market moved up to a new short-term high as buying interest came into the market. Although the market did move up to a new high, the slow stochastics printed a lower high. This is negative divergence and signals the opportunity to enter into a new sell position. Traders will simply enter as the second crossover is confirmed and place their protective buy stop above the higher high. While this indicator can work on any time frame, like all technical analysis, the daily chart will typically offer the better trading opportunities, with the shorter term charts offering more opportunities. It's up to each trader to find the balance between solid opportunities and the number of trades they wish to take advantage of in their approach. But the key is, as always, to trade with the trend and not against it. Before closing, we'd like to discuss a few technical aspects for those who might be interested. There are actually two variations of the stochastic indicator: fast stochastics and slow stochastics. In this video, all of the examples we've been working with use the slow stochastic indicator with the values of 15, 5, and 5. Fast stochastics typically has two parameters that users must specify: %K and %D. %K is the raw stochastics value, while %D is a moving average of %K. Slow stochastics typically has three parameters that users must specify: %K, %D, and %D slow. %K again is the raw stochastics value, with %D as the moving average of %K. And %D slow is a moving average of %D. This means that slow stochastics is essentially a moving average of fast stochastics. Usually this means that using the slow stochastics offers fewer trading signals than fast stochastics, but they can also be more reliable since they typically generate fewer signals. For this reason, we recommend using slow stochastics rather than fast stochastics, with the setting of 15, 5, and 5. To learn more about how to use stochastics in your trading, make sure to utilize all of the great resources available at DailyFX. DailyFX offers a wealth of material, including daily news and analysis on the FX markets, as well as some great forums where users can discuss in-depth concepts and trading ideas, just like we've done here today. Additionally, for those who are interested in really taking trading seriously, enroll in one of our online courses today. We've taught more than 25,000 students about trading FX and would like the opportunity to work with you too. Thanks for watching, and good luck with your trading.